There is an account available to millions of Americans that offers something no other investment account in existence can match. It is tax-free going in. It grows tax-free. And it comes out tax-free on the other side. A Roth IRA is tax-free in and tax-free out. A traditional IRA is tax-deferred going in. A 401k is tax-deferred going in. But a health savings account, an HSA, is the only account that gives you a tax deduction on contributions, tax-free growth on investments, and tax-free withdrawals when used correctly. 3 layers of tax advantage in a single account. No other legal vehicle in the United States offers this combination. And the majority of people who are eligible to use one either do not have one, do not invest the money inside it, or are using it incorrectly. This is week 21 of the Algorithm Investor. Today we are covering the HSA in full. What it is, who qualifies, exactly how the triple tax advantage works, and how to use it as a secret retirement account that most financial advisors never explain properly. Let us start with the basics. A health savings account is a tax-advantaged savings account specifically designed to pay for qualified medical expenses. It is available to anyone enrolled in a high-deductible health plan, an HDHP, which the IRS defines in 2026 as a health insurance plan with a minimum deductible of $1,600 for individuals or $3,200 for families. If your health insurance plan qualifies as an HDHP, you are eligible to open and contribute to an HSA. You do not have to be employed by a specific company. You do not have to meet income requirements. You simply need to be enrolled in a qualifying high-deductible health plan. The 2026 contribution limits are $4,350 for individual coverage and $8,300 for family coverage. If you are 55 or older, you can contribute an additional $1,000 per year as a catch-up contribution. Now let us talk about the triple tax advantage in detail, because understanding each layer is what makes this account so extraordinary. Tax Advantage 1. Contributions are tax deductible. Every dollar you contribute to your HSA is deducted from your taxable income. If you are in the 22% federal tax bracket and contribute $4,000, you immediately save $880 in federal income taxes. In most states, HSA contributions are also deductible from state income taxes, providing an additional layer of savings. If your HSA contributions are made through payroll deduction, which most employer-sponsored HSAs offer, they are deducted before Social Security and Medicare taxes as well. This makes them even more tax efficient than contributions to a traditional IRA, where only income tax is avoided. Tax Advantage 2. Investment growth is completely tax-free. Once your HSA balance exceeds the minimum threshold set by your provider, typically $1,000 to $2,000, you can invest the excess in mutual funds, index funds, or ETFs within the account. That invested money grows completely tax-free. No capital gains tax, no dividend tax, no annual tax event of any kind. This is where most HSA holders leave enormous value on the table. The majority of people with HSAs keep their entire balance in cash, earning minimal interest, rather than investing it in low-cost index funds. An HSA invested in a total market index fund is compounding tax-free, just like a Roth IRA. Keeping it in cash is the equivalent of keeping your Roth IRA in a savings account. Tax Advantage 3. Withdrawals for qualified medical expenses are completely tax-free. When you withdraw HSA funds to pay for qualified medical expenses, which include a remarkably broad list of costs, including doctor visits, prescriptions, dental care, vision care, mental health services, and hundreds of other expenses, you pay zero tax on the withdrawal. Not reduced tax, zero tax. The combination of these 3 advantages is genuinely unique. You never pay tax on the money that goes in. You never pay tax on the growth. and you never pay tax on the money that comes out for medical expenses. The government has created the only complete tax-free investment cycle available to ordinary Americans. Now here's the strategy that transforms the HSA from a healthcare spending account into the most powerful retirement savings tool most people have never fully used. The key insight is this: you are not required to use your HSA funds in the year you contribute them. There is no use it or lose it rule. Unlike flexible spending accounts, FSAs, your HSA balance rolls over indefinitely year after year with no expiration. This means you can contribute to your HSA, invest the money in index funds, pay your current medical expenses out of pocket using regular after-tax money, and let the HSA compound tax-free for decades. Every medical receipt you keep, but do not reimburse yourself for, becomes a future tax-free withdrawal with no time limit. There is no expiration date on HSA reimbursements. You can pay a medical bill out of pocket in 2026, keep the receipt, and reimburse yourself from your HSA in 2040, 14 years later, completely tax-free. This strategy, sometimes called the HSA reimbursement strategy, allows you to build a tax-free investment account that you can tap at any point in the future for any documented medical expense you paid out of pocket at any time in the past. Given that the average American couple is estimated to need approximately $300,000 in healthcare costs in retirement, this strategy creates a tax-free fund specifically sized for one of retirement's largest expenses. There is one more powerful feature of the HSA that makes it function as a complete stealth retirement account. After age 65, the rules change significantly. Once you reach age 65, you can withdraw HSA funds for any purpose, not just qualified medical expenses, and pay ordinary income tax on the withdrawal. No penalty. The HSA becomes functionally identical to a traditional IRA after 65. This means the HSA combines the tax benefits of a traditional IRA before 65, if used for medical expenses, with the flexibility of a traditional IRA after 65 for any purpose. It is a retirement account that you also happen to be able to use tax-free for medical costs at any age. Let us now walk through the optimal HSA strategy step by step. Step 1. Confirm your health plan qualifies as an HDHP. Check the summary of benefits document for your plan or call your insurance provider and ask directly. If your deductible meets the IRS minimum threshold, you are eligible. Step 2. Open an HSA. If your employer offers one through payroll deduction, use it. The pre-Social Security and Medicare tax deduction makes it slightly more efficient than contributing independently. If your employer does not offer one or offers one with high fees, open a standalone HSA at a provider that offers investment options. Fidelity HSA is widely considered the best option in 2026. No fees, no minimums, and access to their zero expense ratio index funds. Step 3. Contribute the maximum each year. $4,350 for individuals. $8,300 for families. If you can only contribute partially, start there and increase over time. Even partial contributions benefit from all three tax advantages. Step 4. Invest the balance in low-cost index funds. Once you exceed your provider's cash minimum, move the excess into a total market index fund. FZROX at Fidelity has zero expense ratio. Your HSA investment strategy should mirror your overall portfolio allocation. Diversified, low cost, long term. Step 5. Pay current medical expenses out of pocket and keep every receipt. Build a digital folder. A simple Google Drive folder works perfectly. And photograph every medical receipt. Doctor co-pays, prescriptions, dental bills, vision expenses, therapy sessions. Every one is a future tax-free HSA withdrawal with no expiration date. Step 6. Let the HSA compound. Do not touch it unless you have a genuine financial emergency. The longer it compounds tax-free, the more powerful it becomes. A 25-year-old who maxes their HSA every year and invests it in index funds could accumulate $300,000 to $500,000 in a completely tax-free healthcare fund by retirement. A few important limitations worth understanding. You cannot contribute to an HSA if you are enrolled in Medicare. Medicare enrollment disqualifies you from new contributions, even if you still have an HDHP through another plan. You also cannot contribute to an HSA if you are claimed as a dependent on someone else's taxes. And you cannot have both an HSA and a general-purpose flexible spending account simultaneously, though a limited-purpose FSA for dental and vision only is compatible with an HSA. The HSA is not for everyone. It requires being enrolled in a high-deductible health plan, which comes with higher out-of-pocket costs when you do need medical care. For people with chronic conditions requiring frequent medical treatment, the higher deductible may outweigh the tax benefits. The optimal HSA user is someone who is relatively healthy, can afford to pay current medical expenses out of pocket, and has the financial discipline to keep the HSA invested, rather than spending it down annually. For those who do qualify and use it correctly, the health savings account is the single most tax-efficient investment vehicle available to ordinary Americans. 3 layers of tax advantage in one account. No income limit, no employer requirement, and the ability to compound tax-free for decades while building a dedicated fund for one of retirement's largest guaranteed expenses. Subscribe to The Algorithm Investor for weekly finance education that actually makes a difference. New video every single week. Drop a comment below. Do you currently have an HSA, and are you investing the balance or keeping it in cash? See you next week.